of a move otherwise. We have Ajay Srivastava joining in, so let's straight away get to him and get his perspective on what we've heard today. Ajay, good morning. Great to have you on. So what did you make of it? None of the rumblings, neither from Wall Street nor this whole yen carry trade. There was a brief mention, but I don't think the RBI governor allowed any of that to influence his decision, at least right now. Your thoughts?
You know, I've always called our RBI governor the most zen RBI governor in any bank in the world. He is zen, absolutely. Yeah. Nothing phases him. The guy just gives you the comfort. He walks in, sits down, gives you the bad news. Now, here is it. He's given you great bad news that the inflation in the current quarter is going to be significantly higher than what they had anticipated. But he gave it in such a nice way, you never felt bad about it. But if you are a saver, if you are a common man, you're going to hurt because the inflation is now mounting. And I think that's been the Achilles heel of the RBI policy, has been inflation. The number two is, I think, great relief for the banks today. They were all coming in with the policy expectation that he is going to be stringent on personal loans. I think nothing happened on that. No increase in weightages, no increase in coverages, nothing at all on the personal loan. It's a great relief for the banks today because they were just, I don't know, I can tell you each of the bankers was apprehending some new measures coming in the personal loans. He's mentioned about top-up loans, etc. But there's no tangible way to restrict loans, and I think banks will be heaving a sigh of relief that yes, happened. NBFCs, now they won't heave a sigh of relief because what they've done is reporting moves from a month to a fortnight, which means their ability to hide a default now goes down. So you had a 1 month to hide a default. Now you have to correct it in 15 days or report in 15 days. So I think it's a great positive for the bank. No restriction on personal lending. It's a pretty big negative for the NBFCs because they will have to now report in every 15 fortnightly, which means time to cover a default in a personal loan or an unsecured loan gets half of what it was before. And maybe next time it's going to be 1 week and it'll become further short. So I think all in all, it's a relief for the banks. All in all, the greatest relief for the Indian economy and the market for all of us is the great pushback to say inflation means inflation. Inflation means not core inflation without food or oil. That's a sustenance. And I think we should take away that this is one fact that the RBI governor has been independent of the political narrative on inflation and is targeting it. He's failing. That's the worst part. With all good intention, he's failing and hurting the savers. But the fact is, today he made a categorical statement, inflation is inflation. And I think that's the greatest positive of today's policy, that one statement saying inflation includes oil, includes food.
Well, absolutely. He set the record straight. Which is the inflation you need to focus on? And that's the headline inflation. Unfortunately, over the next 4 months, the lowest inflation forecast is 4.3% in Q4 of FY25. That's the Jan to March quarter of next calendar year. So it doesn't go below that for the next 12 months. But Ajay, morning. What about the global turmoil that we've seen in the equity markets over the last a week or so now? Do you think it's a bit of an overreaction? What are you advising your clients?
See, the global markets, as Indian investors are concerned, haven't done well. Because if you look at the returns on Indian markets versus what's happened on NASDAQ, what's happened on the Dow Jones, we're not anywhere in comparison zone. So by and large, we were kind of underinvested in most American market. Having said that, people have to understand that American market works lots on leverage. There's so much free-flowing leverage sitting there, the futures and the borrowing, it's rampant there. Compared to look at India, whether it's the HNIs, the PMS, most individual mutual fund investors, they're not leveraged. India's leverage market is very, very small, and cash leverage market is still smaller. So, so contextually speaking, we are far more safer because we don't need to make a margin call every morning and pay off and sell the equity. In US, when the yen trade was unraveling and the yen started to appreciate after this thing, they had to sell. There's no choice. So I think one economic factor only affects much, but the US is one economy which sits on leverage, loves leverage. Other people's money is their mantra, and they pay the price for it. They make super gains because for 10 rupees of capital, they borrow 90, they invest 100. So even as 10% return, they double the money. But when they lose big. So their volatility to large extent, if you ask me, is a product of the leverage economy that sits on it and leverage trading, the hedge funds, compared to our setup, which is very, very cash denominated. People invest surpluses. People don't borrow too much against shares. And therefore, economically, even if same things happen, the impact in US will always be significantly more negative than India because simply he has to pay off the margin call.
But I guess regulators here are worried that we may be going the US or the West way, right? We've seen that from all regulators, from SEBI, RBI, even the economic survey talking about speculation and how it's really, broken the back of many Western markets. But anyway, that's a long debate. I'm not getting into that. The here and now, Ajay. So this is the market, and I think today's policy tells us that the RBI won't be in any hurry to cut rates. The global setup is what it is. What should investors be doing?
Pharma. There is a next colleague of yours is the biggest expert on pharma I have met across. And I think I've known her for almost a decade. She's a pharma expert. She can tell you that pharma is the best place to be for 2-3 reasons. One, of course, you need to buy medicines, right? At the end of the day, whether you like it or not. Number two is the great amount of now we are seeing a deregulation happening in MNC pharma companies being able to bring drugs to India. So MNC pharmas were the worst performers in pharma sector in the last 10 years. They've done a good job in the last 1 to 2 years. I think they'll do a phenomenal job. You saw the reduction in custom duty coming in. Today, they gave exemption that if you have a clinical trial in the EU drug, you can bring it into India without doing a clinical trial into India. So, suddenly the market for MNC pharma companies to bring the global products into India is now expanding and becoming regulatory friendly at this point of time. Our generic pharma companies are doing very well in formulation in India, so they are performing well. All are debt-free, all are surplus in cash, all have decided not to focus on large M&As, all focus on Indian formulation strategy. US, yes, is a pain point, but it's not stopped being a pain point. It's become flat or a little bit of okay. So I think if you look at Indian economy at this point of time and our growth and our demographics, pharma represents the best sector to be, whether it is the end of the product for consumer, the product maker, the formulation makers, or the CDMOs, or the pipeline. That's the best sector to be in India. And as we eat more, as we drink more, you need more medicines, don't you?
Okay, Ajay, we'll leave the conversation here for now. Point well made. Pharma is the place to be if you want to look at India. But we need to get into a break. We'll come back with more on the markets.